Okay, guys, this is being recorded. One thing I always mention at the beginning of every single webinar is watch this again. And even somebody reached out to me not too long ago. When I do these webinars, I may do the same one where it's the short put, okay? But we're going to be specifically talking about volatility today and really digging down on that. Some of my other ones are dealing with different aspects of selling the short put. So I have no problem you watching another one in line with this, the one we're doing today, like say a short put, and then you look at a different short put one. Because I will talk about different aspects in more detail from those other ones, depending on what the course is about. And this one being about volatility, I'm going to try and specifically narrow down on volatility. Ted saying, are there any other members close to me that I might be able to communicate with? Ted, I don't know if there's anybody over there in Westminster, MD. What is that? What is Merit MD? Anyway, so we're going to be doing the short put, but let me get a couple things out of the way. Maryland, that's right. I'm not good on my abbreviations, obviously. Anybody out in Westminster, Maryland? Ted wants to get a trading group together, I guess. All right, so my name is Eric Wilkinson. Some of you guys may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. I started out trading in college with a psychology degree, believe it or not, and then started switching that over to finance. But in that time, after graduating to now, I basically traded just about everything from stocks, financial futures, commodity futures, currencies, and options on all these products and just about all market conditions. Go over this disclaimer real quick. Basically, it says any opinions, news, research, and analysis or other information contained here or material provided by Pro Trader Strategies and or associated companies or employees is for general commentary and does not constitute investment advice. What we're trying to do here, you guys, what this breaks down to is we're trying to teach you through my rules how to trade options. Now, it's up to you to discern whether or not it is appropriate for you and your risk parameters and your portfolio, okay? Bottom line is do your own homework, and past performance of any trading system or methodology is not necessarily indicative of future results. Ultimately, we're trying to teach you guys how to trade this stuff, not just give away trades. That's not what we are here to do. I want to teach you guys how to swim. I'm not here to swim for you. All right. You guys can follow me on Twitter at Wolfman's blog or our parent company at Pro Trader Strat. Right now, I'm going to be tweeting out like I did today, earnings trades that I'm going to be doing because I don't have, I do the daily market commentaries where I talk about all my trades in and out. In the morning, I put my earnings trades on in the afternoon, so I just tweet those out so you guys can play along and follow along with my trading, all right? So you can follow me there too. All right, this is on the short put. One thing to note, though, with all of these option strategies, you guys, never be a one-trick pony where you just always do the iron condor or you always do the straddle, you always just sell puts. If you're a one-trick pony, you are still beholden to the market. Switch it all up. Sometimes you're putting on short puts, sometimes you're putting on long puts, and you have a mix of all that stuff in your portfolio. Make sure you always have a good mix of these different option strategies in your portfolio. All right, but with the short put, one thing we have to have is a bullish assumption. It can be market neutral. We just don't really want this to have a bearish assumption. We would do a different strategy altogether. And, you know, if you have a specific market neutral assumption, there's better strategies, okay? But this is a bullish assumption. You know, you can get away with it if it is the market is neutral because we are going to be exploiting a couple of things that will help us out as the market either slightly moves higher or just trends sideways. We just do not want a big bearish move with this one. All right. With that being said, we're going to be exploiting theta decay. Now remember, theta decreases every single day. And what we're going to be looking at specifically is with theta right here, you can see theta decreases by 76 cents on these options per day. Well, there's only one day left, but you can see that theta really starts eroding the closer we get to expiration, about 29 days. Theta 43 cents a day out of Chipotle, okay? Further out in time, we get out 50 plus days, you can see it's only like 26 cents a day for those further out. So we are going to be trying to exploit the best theta decay, you know, for the bang for our buck, in a sense. You know, we could exploit theta decay in here, but we're just not going to make that much money on these in one day. So we're going to look at it a little bit further out and get this move here. Also, when you get in too tight to the markets, we start having other aspects of this kind of inflate with the gamma and stuff is going to affect your move if it goes against you quickly. So as you can see, the gamma is not really affecting us out here as much. Theta being pretty good. That's the wheelhouse we're going to be looking at. But we want to exploit this. Every day that goes by, 43 cents comes out of this contract. And it's different for every underlying. We could look at one that has a little bit smaller price. And you can see 18 cents a day out of this strike here, 40 cents really close to the money. And then you go out in time, we're getting about 10 cents on these that we're going to be playing around with. So we're going to be exploiting theta decay. But most importantly, we want to take advantage of this volatility crush, because as volatility comes out, that's really where you're going to make your money when you are selling options. Anytime you're selling options, when we are getting this volatility crush like we've been seeing the past couple of weeks, that's where you can make your money. We had a bullish move, volatility collapsing. Great environment right now for selling option strategies. I can't emphasize that enough. If you have ever wanted to step into selling option strategies, right now is the time. And it may seem counterintuitive when everybody else is screaming the sky is falling, and that's basically when we're in there selling option strategies, because when fear is at its greatest, that's when we want to take advantage of that volatility, because volatility reverts back to the mean. We can look at all these charts and see what volatility has been doing. And you can see volatility comes out. This is the volatility crush I'm talking about. You get these down spikes. That's volatility crushing out of this market. So we talked about those. We saw the option montage, and you can see that it went from 51 to, let's just say, you know, right here, 41. So that's 10 percentage points coming out of Chipotle in just a few days. So if 10 percentage points came out of Chipotle, this pricing decreases by this amount for every 1 percentage point decrease in volatility. So 10 percentage points has come out of this option montage, all right, in the last few days. So 10, let's just ballpark it. Let's say 10 cents a day, 11 cents, $1's come out of this in the last 10 days. Even if it wouldn't have moved, that same amount of money would have come out of this option. If we didn't, last 10 days, it didn't move eBay from $30.38 to 10 days later, we're $30.38. All that, you know, you would have some of the theta coming out too, that 10 cent or 10 days with the 2 cents. But what more important, you can see that 10 days, 10 percentage points coming out is much greater than even the theta contraction. Okay. So 10 days goes by, you get this 10 days of 2 cents a day coming out of these. And then, 10 days with that 10 percentage point decrease, 10 percentage point decrease in this contract, you would have lost another $1, okay? Which is good, because when we're selling, and I'm looking at the calls right now, you can look at the puts and see that they're very similar with the volatility coming out, the 3 cents. Sorry, I was looking at gamma, you guys, on this. The Vega, 10 cents a day, 10 percentage points, 3 cents per percentage point, we would see that decrease by 30 cents. I was looking at the wrong one. Sorry, I was looking at gamma. That was incorrect. When I'm talking about the volatility on this chart coming out by 10 percentage points from 51 to 41. That's volatility. When we go over to the option montage, we look at the Vega and see that 10 percentage points here times 3 cents, 30 cents would have come out of that. So still greater than the theta coming out. All right. So volatility will help us when it comes out much greater than even that theta. And you could see that volatility come out. You could see 10 percentage points come out of volatility in a single day. All right. Even intraday, you could see that happening. So volatility is really what we want to see come out when we're selling this strategy. All right. So volatility, really important. We need to have high volatility then in order to sell this, because you can't have low volatility and have a crush. It's not going to crush anywhere. It's already low. So we want high volatility and have it come out. All right. Essentials to success. I've mentioned this several times. Volatility. When I talk about the right environment for selling a short put naked, we need high implied volatility percent. That is a little bit different than volatility. Okay. Volatility percent is where that volatility is now in relation to where it's been. So when we were looking at this same chart, we can go back to it. And this is where its current volatility is 38. We saw that in the option montage. It's 38. But what it's not telling us right now is where volatility is now in relation to where it's been will tell us kind of where it wants to go in the future. Because when it's really high, you can see it wants to revert back to this mean, the very middle. And when it's really low, it wants to revert back to the mean towards the middle. So when it's low, it wants to rise. And when it's high, it wants to come back down, as we are seeing now. So we would expect eBay to continue this slide back to about the middle of the road, or the median. All right. So with IV percent, though, we need high IV percent, above 50 IV percent for a stock, above 30 IV percent for an ETF. Stocks all have a different volatility. This eBay volatility 38 is right close to middle of the road for eBay, but 38 might be an extreme low for, say, Tesla or something that's, a tech stock. All right. So we can't just look at this number and say if it's high or low. We have to look at this number in relation to where it's been. So for IV percent, we have a numerator and a denominator. In the numerator, we take the sum of the current IV minus the low and divide that by the sum of the high minus the low. So right now we have 38 in the numerator minus 15. So we have 23, right? In the numerator, we have 23. So 23 divided by 52 minus 15. So 52 minus 15 is 37. So 22 minus 37 gives us somewhere around 65 or something percent. So if we did in the math, we'd come out with 62. All right. So that's how they come up with it. They take it all the way out to the decimal and do it exactly. I did it for the ballpark just to give you an idea. All right. You can do that in your head also on yours. It doesn't have to be super exact, but we want something above 50 for selling premium on an underlying that is a regular stock, and for an ETF, something above 30. The reason why ETFs are a little bit lower threshold is because there's so many different underlyings in that ETF. Those volatility coefficients will kind of average each other out or meld each other out a little bit lower. So we'll go a little bit lower for the ETFs. All right. So that is picking the right environment. We need implied volatility percent above 50 for any individual underlying and above 30 IV percent for an ETF. All right. All right. Picking the right underlying. The picking the right underlying is pretty simple, you guys. Basically, what I'm trying to do is avoid pitfalls of giving up too much edge or not understanding option pricing. Okay. So if you're a newer trader, even if you've been trading for 10 years, some people don't necessarily know exactly how the option pricing works, believe it or not. So for us to avoid that, an underlying that has a price of under $100. So eBay, under $100. Our option montage closest to expiration, the monthly's closest to expiration, which is this one. The spot month is what we used to call it on the floor. You know, this is the closest monthly to expiration, but mind you, people have moved out of this option contract and into the longer duration around the 30 to 35 days to expiration is usually the spot month. So they rolled out there and more volume and open interest is going to be taking place out here. The reason why we want more volume and open interest is because that means there's more eyeballs on this. There's more people that have a vested interest in keeping an eye on their position. So we want to get into these. So a stock under $100 from the bid to the ask in the option montage, the ones that are just out of the money, closest to at the money, we need that inside 10 cents wide. eBay fits that rule. On a stock that's over $100, let's say IBM, we just move the decimal 3 ticks to the left and 12 cents wide should be what the option montage is for the monthlies closest to 35 days. So you'll see that this fits that rule for the most part with the 12 cents wide. So follow that rule, 12 to 13 cents wide here. Follow that rule. Just when you're first learning, just move that decimal place over. That's how wide it should be. If it's too wide, like double the width of, you know, this is 30 cents wide, get away, stay away from it. You all have to give up 10, 15 cents to get in and then that 10, 15 cents to get out. It's just too much wiggle room. And that 30 cents, you kind of just threw out the window. All right. Because there's one guy waiting for you to come to him rather than when there's a lot of eyeballs in there. If I bid, 40 cents here, somebody else is going to come in and offer 250. All right. Because they want to step in front of the current offer so that they get filled first. All right. And then when you have so many people trying to do that, that's real free market price discovery as people tighten up that market. All right. Like you'd see Apple with, penny wides almost. If we flip up Apple, sometimes these during the day sessions are 2-3 cents wide. Okay. After the close, these are going to be wider. That rule is not going to necessarily fit because people cancel their orders. When the market closes, all my orders in the queue that aren't GTCs get canceled and it's not reflective in the market anymore. All right. And then picking the right duration. I've kind of mentioned this. We went over it a little bit when we pulled up that option montage talking about exploiting theta. We want theta to be, at its greatest. Obviously, we talked about this one day ago. That is at its greatest, but you would have to sell these at the monies to get anything, right? And that's pretty risky. So we're going to go a little bit further out, this 35 days to expiration, because we get the best theta decay going on. All right. And I'll show you here on a chart. So we're going to be losing like 7-8 cents a day on these options, probably closer to 6-5 cents a day on the strikes that we are going to be picking. And we're going to be picking puts. And I'm sorry I keep looking at the calls over there, but that's a bad habit. We're going to be looking at these. The theta you can see is 5-6 cents a day on the strikes that we're going to be looking at. And why are we looking at that 35 days to expiration? Because if we look at the monies, and we're not going to be doing the at the monies, but this is a very good visual representation of theta decay going on. And what we can see is farther out, it starts flattening. It gets, you can see that there is less theta decay going on way out here. And the further out you go, it even flattens out even more. But once we get inside this 35 days to expiration you keep hearing me talk about, we get 50% drop in our premiums over these next 20 days. All right. That all else being equal, nothing else happens. Volatility doesn't change. The market doesn't change. The price of the underlying hasn't changed. Nothing else has changed, but that theta decay component loses 50% of its premium in the next 20 some days. We couple that with that volatility coming out, right? We can see massive reductions in our premiums very quickly, which is what we want. We sell high, buy low, right? When you're selling premium, you want to sell it high, see that theta come out, see that volatility come out. all right? And picking the right strikes. This is stuff that people don't tell you online. When you go out and learn how to do a strategy online, they're just going to tell you to sell a put. I don't even know if they're going to necessarily tell you to sell an out of the money put or where the most optimal strike location is for your risk. All right. I do that. And the fact of the matter is what I found is one standard deviation away, which is equivalent to a 16 delta, is where we should be looking to sell. All right. Stocks, under $100, that one standard deviation, you're going to be able to collect about 30 cents for it, 30 to 45 cents right now. All right. This is the bell curve. This is what I was talking about. One standard deviation. If we think of this as being the puts because they're negative and this is the calls because they're positive, one standard deviation move, you add up all of these percentage points all the way out, it will come up to, close to 16%. So that's the one standard deviation. That means we have a probability of this underlying finishing over here is about 84% probability. So the probability of it coming and finishing over here is only a 16% probability. All right. That's pretty good chances of us being successful when we have an 84% probability of being right. Okay. So we want to sell that 16 delta, and people online are not going to tell you that for whatever reason. They don't understand. All right. The reason why I'm trying to teach you guys all of these little nuances is to take the fear out of it. One of the hardest things to do in trading is pull that trigger, right? To actually send it off into the market to get filled. And the reason why is because we second guess ourselves and we start wondering, are we doing the right thing? That's why I have these essentials to success, you guys, and lockstep one by one so that you guys will be able to look at this. And by the time you've gotten through these essentials to success and are ready to pull the trigger, you're confident. There aren't unknowns. You should know what is going to happen going forward. All right. You'll be able to count on it. And if it doesn't, then, pull the ripcord. It didn't follow what you were thinking and you get out right away. Okay. And finally, let's look at our key is getting out, right? Online, do they tell you where you should be getting out of these strategies? Do they tell you when and where you guys should be getting out? I'm telling you guys, when you sell this option strategy and it decreases by about 50%, that's when we're looking to get out, all right? If you're collecting only 30 cents, which is about the minimum I'm going to accept as a collection when I'm selling a short put, then you might need to go a little bit more than 50% because it's only 15%. And after all the commissions and everything else, they're going to have made more than you. So you might need to squeeze that out a little bit more, maybe cover it for a dime. I would not ride any option strategy, guys. If you don't take anything else from this webinar, don't ride option strategies out into the sunset. All right. Get out while the getting's good. Your probabilities of success, are the probabilities you're going to see on the delta. But when you get out early, you've increased your success rate dramatically. All right. So get out early. 50% drawdown is what I'm looking for. If you guys have an exit or want to know an exit for a loser, usually I'm kind of looking at 3 times the credit received is where I'm getting out. So if I collected 50 cents, I'm getting out when it's trading around $1.50. I usually will let it ride out a little bit longer or a little bit more than that, depending on your risk parameters. I'm thinking of somebody that has a lower risk parameter 3 times. All right. The other thing is, if you guys like trading with Fibonacci or market profile or the clouds or Bollinger Bands, any of that stuff, okay? You can use that for your exit. For me, if I were selling puts in Apple, for instance, I would try to get below the 142 low because we've already had this sell-off somewhere down here at the 142s if I could, if it fit all the other rules. And then, you know, it has an earnings. You can see that. I wouldn't trade this far in advance of an earnings, but pretend when we're going through these examples, there's no earnings coming up on these examples, okay? I have different rules for a earnings specific trade, okay? And make sure you check that out at Pro Trader Strategies. You can get those earnings trades. They're completely separate rules. But if we didn't have earnings in here, we can see it's above an IV percent of 50. We don't have to do the math because I put the code in my watch list. I have the code for that you can create part of your watch list with that. But for instance, if I sold these, I might say once it gets below the value area low, I'm out, okay? It probably wouldn't get to that increase in my premium size at that point. The other thing, you know, or a Fibonacci, if I'd sold it, you know, it broke a support level, then you can do that as well. Steven or 7, that's what you're going to have to reach out to us to get that the code and how to set that up in your toss. I have the code for it that you have to build it out and put it in there. Okay, so you know, on your exit, if it broke a support area or something like that, I have no problem with you using that. Just stay consistent with it so that you have the data. One of the other things is with all of these essentials to success, write everything down, you guys, so that you have the data to go back and look at and check yourself. You know, picking the right environment. What was the IV percent of this? Picking the right underlying. Who was the underlying? The duration. What duration did I use? The strike price. What was my market assumption? That's not something on here, but we have to have a market assumption. What was my assumption and why? And finally, your exit strategy. Write that down, because when you don't write down when you're going to get out, it's so easy to just kind of let that get brushed under the rug, all right? And if you want to be mechanical and stay consistent, write it down so that when that number comes up, you get out. You're holding yourself accountable at that point. When it's just kind of in your head, you don't ever really hold yourself accountable. And that's when things start going awry, right? So get out according to my rules, 50% of max profit on this. Or if it breaks your Fibonacci or one of your support levels, write that level down. If it breaks this level, I'm out on a loser. And if it gets to this point, my premium is this, I'm getting out for this. Write it down and stick to it, right? So then after 3-4 months, you can go back. Is this working? Right? Max profit. Max profit on any premium selling strategy is that premium received minus those commissions. That's going to be our max profit. And that's if we wrote it into expiration all the way to it expires worthless, which I don't do. I'm getting out for 50% of my max profit on this one. Max loss is unlimited, right? To zero, or it's limited to zero, but that's going to feel like it's unlimited. That's why I put unlimited there. Don't ever do that. Don't ever ride anything out that far, right? That's just ridiculous. And another thing is, if your market assumption is still the same, something with that exit strategy, if your market assumption is still intact, that you're bullish, the market has maybe made a correction and you're being tested on your puts, I have no problem with you rolling those puts out in time and collecting more of a credit. That's being mechanical, and that is only if your market assumption has not changed. If your market assumption ever changes, immediately get out. I don't care if it's profitable or loss or whatever it is. As soon as your gut tells you, maybe I should get out of this, I'm telling you right now, that is the time to get out, right? Never fade your gut instinct. We can talk ourselves out of following a gut instinct easily, all right? We can always find reasons to not follow that instinct. I'm telling you, you have to follow that instinct. Why? Because it is the most basic part of our brain. And that part of our brain doesn't really have a voice. It can only really give out a feeling, or this isn't feeling right, is what we always kind of say, because that voice doesn't say specifically what about this is wrong. Okay. or right for that matter. If your gut tells you to do something, that's probably the right thing to do because it's your limbic brain. It basically compiles everything into this little machine, and it comes up with theories, believe it or not, and tries to push it out. It's our most basic instincts that it's trying to prevent us from making a mistake. So go with that. I can't emphasize it enough. That goes back to my psychology degree and following your gut. Seriously, as traders, we need to go with that. Follow that gut instinct. All right. Break even is when the price of our short put minus the premium is our break even. Remember, our short put, we collect a premium, which is going to reduce our break even. All right. If we pick a 100 strike and we collect $1, then our break even is then $99 when the underlying is traded down to $99 through our strike by $1 at expiration. That is our break even. All right. So this is a part of the webinar where I throw it out to you guys. Let's go through all of these steps like it was a real trade and see if it works out. So you guys throw out in the questions box. That's how we'll be communicating some stocks that you think are prime and ready to move higher, have high volatility. I don't care if they have options or if they have an earnings in them. We're not going to be able to find too many with high volatility that don't have earnings right now because we are just in the thick of it. Netflix comes out with earnings tonight. So does American Express, and we got a couple banks already. So we are heading into it. All right. So first one, somebody's throwing up Apple. We got Apple right away. So what I'm looking for, picking the right underlying, right? Or let's start with picking the right environment. So picking the right environment, we need an IV percent of above 50. So we could do the math here. You know, the current IV minus the low. Take that sum and divide it by the high minus the low. And lo and behold, we come up with 51.51. One other thing on toss, somebody was asking how do you get it in the watch list. One thing with the watch list, I have the code for that. But if you just look on the option montage right down here, it's going to round it, but you can see the IV percent right there. Okay, so it's above 50. That makes it okay. The next thing we're looking at is picking the right underlying. So we go to the monthlies that will have the most volume and open interest. We can click on volume and open interest right here and see that look at all this open interest and all this volume going on any given day, right? That's what we really would like to see on every single options contract that we trade. It's not the case necessarily, but on both sides, we can see that. Definitely more call trading going on, so people are bullish. So what was I going to go do? Delta and the gamma. So then picking the right underlying, we know that this fits that rule. 3 ticks to the left, Apple 15 cents wide. We're inside that. We're good to go. Next thing is the duration. We're picking that closest to expiration with the most volume and open interest, 29 days is closest to that 35 days to expiration. So that's what we're looking for there. And then finally, we're looking for picking the right strike. I said pick the 16 delta, right? You're not always going to have that exact 16 delta. So what I would say is if you are wildly bullish, then maybe go closer. And if you're not so sure, maybe go a little bit further away, all right? I will generally default for a little bit further away because my probabilities of success are greater, right? So, this is a 13% probability of me losing. This is a 21% probability of me losing, or a 79% probability of success, or a 87% probability of success, almost a 90% probability of success. I think I would go with this one. And then when I've sold that one, if I went in to sell this trade, then you could see that what's my exit strategy at 50% of my max profit. My max profit is $1. I collected $1. So 51 cents is where I'm going to be looking to get out. I write all of those things I just went through down. I'm bullish in Apple because I love Apple, and they've been beaten up. You know, I mean, who couldn't argue with a pullback, you know, after this much of a beat down in Apple? So I'm bullish in Apple. I'm below the 140 strike. That's I'm at the 140 strike, but I'm below it because I've collected that dollar, right? My break even now is 139. Break even is that dollar minus the strike is our break even, because I get to keep that collection. So my break even is now 139. So that puts me well below this low. But in my, you know, exit strategy on a loser, I would probably, for me, I'm selling that 140 strike. If we broke below 142, I'd be out. It's a new low. I don't know where we're going after that. All right. So I would write, if Apple breaks 142, I'm out. I don't care what is happening. You know, it could be, you know, 20 days from now, and I've collected a lot of premium, volatilities come out, all of those things, and maybe I'm at, you know, 30%, you know, or actually I've only collected 30 cents, you know, it's still 70 cents. I originally sold it for $1. It's decayed by 30 cents. And, you know, I'm at 70 cents, but it's starting to break this low. I'm probably getting out, right? So, and I would write that down. If it breaks 142 in Apple, I'm out, because it's broken my, you know, chart pattern or something like that, okay? So make sure you follow with all of those things, all right? Facebook, let's check out Facebook. If we were looking at this, we're bullish Facebook. So we go through their steps. Is it the right environment? It's got a 64 IB%. Yes, it's the right environment. High implied volatility. Look at this one. Well, there's no earnings. I think there is earnings, but that's one thing we want to check with this, is that we don't have earnings. And if we do have earnings, then we're following the earnings rules. But we're assuming this doesn't have earnings coming out. So let's take a look at it. That's picking the right environment. We see we have the right environment. Now we're going to be looking at the right underlying. Apple moves the ticks, 3 ticks to the left, 15 cents wide. Does it fit that rule? Yes. In the calls and puts on the options closest to expiration, we are inside of that, especially during a day session. All right. The next thing we're looking at, the duration. Yes, we picked the right duration. That's the closest to that 35 days to expiration that I'm looking for. That's what we're looking for. This is another thing. Look at this volatility coming out of it. 16 cents for every percentage point drop. That's a great thing. I mean, if we see volatility coming out as we would expect, then we get that 17 cents per percentage point drop. And you can see on the chart, those moves, like when I'm talking 1 percentage point a day, you can see that that can easily happen. Those are easily percentage points in a day, right? A lot of times. Right? So we're looking for that volatility come out. We're expecting this volatility to continue back down to the mean anyway, which would be another, if the mean is 50 ID%, right? Then we've got another 14, 15 ticks or 15 percentage points of down ticking, right? To get to 50, if it goes down by 15 percentage points, that's, $16.50. So we're looking about $2.20 some cents or something, right? That, with math in my head, over those percentage point drops. So that would be a nice little move. That works out. And then finally, we are picking the right strike. So we look for that 16 delta. Again, it's a pick 'em. What am I going to do? I'm probably going to go a little bit further away and sell the one that's just slightly out a little further away. So we start at the 16 delta. I lean towards less deltas or higher probability of success. I have no problem if you're always leaning towards this one, right? I'm just going to roll out. You would have, I have a high risk tolerance, but you would have a higher risk tolerance than me if you were going to do that, all right? Does anybody else have any other questions right away before I move on? All right. Pretty simple. I mean, like I said, I try to break all of this stuff down so that we take the fear out of it. One of the biggest complaints I hear is I just couldn't pull the trigger. And the reason why people can't pull the trigger is because they're not confident. And I'm trying to give you that confidence in order to pull the trigger. If anything, sometimes I get in that whole thing where should I or shouldn't I pull the trigger? Well, I would say pull the trigger. Go, like in this particular instance, go a little bit lower delta, less premium, but higher probability of success, and you get in. All right. The best way to start, getting into this and being more confident is get your feet wet. I'm taking the fear out of it so that you know the knowns, and the only way to really build your confidence is to create more opportunities. And then those opportunities will show you the probabilities are correct, and you will be more confident and be able to put on more trades. So that's what I'm trying to do here, you guys. Make you guys see it for what it is. Takes the fear out. You see the known. Now you're confident. All right. You can pull that trigger. You know when to get in. You know when to get out. You just follow these steps. All right. Does it fit? Does it fit? Yes, yes, yes. We're green lighted. Let's do it. All right. So, I mean, how many contracts would you risk taking? Okay. So this is up to your risk parameters and your portfolio. So the way I would look at it is as in percentage terms. I would not dedicate any one assumption, being my Apple bullish assumption, more than 10% of my portfolio value. Okay. So if I had 100,000 contracts, I would not be doing more than 10 calls or 10 short puts in this particular strategy. If wrong, do you defend the trade or accept the loss? Banu, if my market assumption changes, I'm accepting a loss. If I really wanted to defend this trade, the best way to really defend this trade is to roll it out in time if my market assumption has changed. Let's just say, well, the market's moved down to this level and you can see it's right there close to your strike. You're being tested on it. Maybe it's not breached yet, but you're kind of starting to worry. Then you could sell a call, maybe a 16 delta call around that, collect more credit, create a strangle. So there's a couple of other things you can do depending on what your assumption is. If your assumption is bearish, pull the ripcord, get out of it. If your if your market assumptions change to bearish, if your market assumption is still intact and you're bullish and the market's just done this little maybe slight correction and you just don't have enough time left in the month to get there, then roll it out in time, collect more credit, more premium that will decay. So you increase your probability of success. You've lowered your break even more by that amount that you've collected. So you can do that, create that strangle to collect it. If you're, all right. So did I answer your question there? You can pull the ripcord on it, sell a call against it if you're kind of thinking it's becoming more market neutral now. But if you're still very bullish and it's just done a correction that you didn't like, then roll it out in time and collect more premium. Okay. I think I got those two questions. I see, William, I see you got one, but it's going to take me a second to answer your question. So basically, premium membership trial, you guys get my daily market commentaries in this. Not all of my courses have the daily market commentary, but when you do the premium membership trial, you get that. All right. Daily market commentaries. You also have unlimited access to me, which isn't on here with the premium membership trial. So if you have, or premium membership, if you have any questions whatsoever, if something's gone against you, you want me to, get back to you, I have a no inbox policy, meaning in my email, if you guys reach out to me, I'm going to answer you as quickly as humanly possible because I know what it's like, right? You want those answers. I'm going to give those to you as quickly as humanly possible. Also, you get the top option workshop videos. We've reorganized all of these now, so it's a little bit easier to search and figure out. You can check off the list as you go, so you're not watching the same one over and over again. You'll be able to see you've already watched it. And you get free access to the online options trading workshops, plus premium memberships. You'll receive access to the trading courses free, which is hundreds of videos at this point that you'll have access to till your heart's desire. So like you'll be able to watch all of the different short put ones that I've done, because I talk about different nuances in each of those. And 1 month for only $7, you cannot beat this. This is the best deal we give. So if you guys want to become more confident traders and take that fear out of trading, this is what you guys should be doing, taking that premium membership trial, because I go through every single trade that I do, when and where I see those trades appropriate for me. It's up to you to determine whether or not they're appropriate for you, but take that next step, get into this, become a confident trader. All right. So the link is in, somebody's asking, I forgot to hit the link. The link is in the chat window. We've been going back and forth in the questions box. I just sent out the link through the chat window. That is a hot link. You can click right on it. If you're watching this on tape delay, like I said, hey, watch this again. And now you're taking advantage of it. You're going to have to pause this video and type this into your URL. All right. So I just want to thank you guys all. In later webinars, I'll be drilling down on different option components, when and where I find those options trades appropriate. Also, I want to thank you guys all for watching. If you have any questions, reach out to us at 310-598-6677 or email us at trading@protraderstrategies.com. All right. So earnings trades, I'm going to be talking about all of those, all of my, like I said, all of my trades. I also talk about the geopolitical stuff. I go over all of the economic data that comes out every day and tell you what I think that means for the economy going forward. So a lot of great stuff in here. Not only just building your education, but I'm also teaching or building your education about options. I'm teaching you guys literally how to trade. One thing, somebody asked me, I want to get in and out of these. I want to make the quick money. The best way to make fast money and to get in and out of trades is to know value. All right. If you know value immediately, you can make that trade happen. And I teach that, how to find value, where value is expensive and it's overvalued, and where value is cheap and it's undervalued. Okay. That is the key to success of getting in and out of trades quickly, making that money. All right. And I teach just that. So take advantage of this. Like I said, it is the best deal in the house. And that link is in the chat window. Otherwise, you're going to have to go back and pause it on that other link to type it into your URL. So great deal for $7. All right. I see a couple questions popping up, so I'll get to those. Excuse me, real quick. Yeah, it's over there in the chat window. Debits in your example, sell the call separately, or should it be a debit spread strategy? Well, I would sell the call separately, right? I was unavoidably late. Is there a recording of this presentation? Yes, Cindy, it is. And one thing I would say, Cindy, watch this one and then go back into the archives, watch another short put video so that it really solidifies what we're talking about. You can watch the same one again, which is really what I kind of usually say. So work that out. Eric, would you agree, would you agree, Eric, that it would be more conservative when your probability of touch is outside the expected move, below 30%? Example, under a 15 delta, just a little bit more safety. You could, William, that 16 delta is a really good one. And, it is probably the best bang for your buck. If you have a little bit less of, a lower risk tolerance, then yeah, move out there a little bit. Just make sure you're at least getting 30 cents for it. One other thing that some of you guys may not have caught there, but William said the probability of touch. Now, on the floor, what we used to say is that was like the probability of getting touched or the probability of being kissed, meaning the market in this time, we picked this 13 delta, probabilities of Facebook finishing in the money in the next, in 29 days from now, the probability of Facebook finishing in the money by 1 penny, meaning 29 days from now, this market expires, or this option basically is going off. The probability of this strike being in the penny or in the money by 1 penny is 13%. So being it trading 129.99, right? That would be a 13% probability. But the probability being touched or probability of being kissed is the market comes down in the next 25 or 29 days, trades 130, and then comes back up. That probability is 2 times the delta. So when we were talking about the 16 delta, that probability would be 32. In this case, it would be 26. So there's a 26% probability in the next 29 days that Facebook will come down and trade 30 and then come back up. Okay. But I have no problem. If you guys want to roll it out a little bit further and lean towards that one, I have no problem. Just make sure you at least get 30 cents. Otherwise, it starts making it difficult to make some money on this one. All right. All right, that's it, you guys. Like I said, for $7, the premium membership is, you get everything. Absolutely. Everything is out there. It's not a la carte. It's just, it's a smorgasbord. So take advantage of it. All right, guys, that's all I got for you guys today. Oh, one last thing. If you guys have, if you guys are some of my regulars or you've enjoyed this video, one thing we've been doing is sending out some surveys, asking how we've done. Please, if you think I've done a good job, give me a good mark. It really goes a very long way. Those things help us with Google and traction and everything else. And if you think that there's people out there that could benefit from the way that I teach trading options, I would appreciate you giving me a survey response. If you don't like what I do, reach out to me. Tell me what it was that drove you nuts. And, if it's bugging you, it's probably bugging somebody else, and I'll try and make changes so that I can get a good mark from you the next time. But please fill out those surveys for us. It really, really helps. Okay? That's all I got. If you can't take that, take it easy. Take care, everybody.